All right, good afternoon, everyone. Let's go ahead and get started. And on behalf of the National Glass Association, I'm Sarah Neiswanger, Associate Director of Industry Engagement, and I'm joined by my colleague, Lori Cowan, editor of Window and Door magazine. And thank you for joining us for today's Thirsty Thursday webinar featuring Chris Beard of John Burns Research and Consulting. Before we begin, let's take a look at what's happening around the NGA. The NGA Glass Conference in Milwaukee is now less than a month away. High-performing glass is a theme here, with VIG on display, both in the meeting room discussions and about town. You'll be treated to a virtual walking tour of iconic buildings in our host city, including an award-winning timber curtain wall project, a VIG installation, Milwaukee's tallest building, and a bird-friendly LEED Silver certified arena. And remember, these events, meaning the NGA Glass conferences, are some of the best places to be on the front lines to learn about some of the newest issues and developments coming into the glass industry, to understand how and why decisions are made early on that will impact the evolution of the industry a year or more down the line. So if you haven't been before, we do hope you'll give it a try. Glass Build America is nearly 2 months away. Registration for your exhibit booth personnel is already open, and registration opens for everyone else next Tuesday, July 16th. So be sure to plan your travel to stay for the Glass Build after party. That's on the final day of the trade show. The Magic of Glass after party will capture the excitement of Orlando, which is our new host city for Glass Build in 2025. It's just $10 to add the after party ticket to your registration, and proceeds will benefit the NGA Foundation towards industry education and resources. So we hope you'll plan to stay for that. And very timely today, Chris Beard will actually be one of our presenters on the main stage at Glass Build. So you'll get to meet him live and in person in just a couple of months. I'm now pleased to introduce my colleague, Lori Cowan. Lori is editor of Window and Door magazine. She has 16 years experience in editing trade publications for the construction industry and has been with NGA for the past 5 years. She'll tell you a bit more about what to expect with today's session. Hi, Lori.
Hi, Sarah. Thank you so much for the introduction. All right, so before I introduce Chris Beard, I wanted to take a couple minutes to go over the results from the 2024 Top Manufacturers Report, which you can find in the May-June issue of Window and Door magazine. I'll spend just a couple minutes discussing some of the macro trends in the big picture that we're seeing within the overall building products industry and construction before launching into the results specific from the survey we did. So one of the things we have been continuing to see is new home construction continues to fall. It's at its lowest pace since November of last year, and most people seem to cite affordability as the biggest challenge. Only 29% of first-time homebuyers could afford homes for sale nationally in Q1, which is down 5 percentage points from 1 year ago. Research from the Joint Center for Housing Studies at Harvard University also confirms this. They found that home prices have increased 47% since 2020, and the median home sales price is about 5 times the median household income. Remodeling and owner-occupied homes is also expected to decline this year, but it's not going to be as fast as of a decline as we have seen in the previous couple of years. I also took a look at some of the stats from the National Association of Manufacturers from their most recent survey. Almost 72% feel somewhat or very positive about their company's outlook, which is the 7th straight reading below their moving average of almost 75%. A large portion of respondents to that survey cite the inability to attract and retain employees as their top challenge, as well as healthcare costs, an unfavorable business climate, and a weaker domestic economy. So going into some of the results from our survey, which we completed in March of this year, we got some really interesting qualitative commentary around sales and growth. Nearly all companies added production in 2023. A little more than half had increased sales, and a quarter had sales that were unchanged year over year. Despite some slowing down, many companies report increased investments in high performance products and have also noted that the luxury market seems to be fairly insulated from a lot of the economic hardship. One company even mentioned that they're really optimistic about next year and anticipate a double-digit increase in 2025. So we also talked with the manufacturers about some of their reports, um, about some of the challenge and their business opportunities that they see in the coming year. Companies continue to focus on the entire business view and taking a more holistic approach, which I think the similar percentage points in business investment with marketing, equipment updates, software updates, and new product introductions are so close to each other. I think that really reflects their 360-degree focus. Other notable opportunities include energy efficiency, acquisitions, growing the existing customer base, and expanding facilities and product lines. It's not a big surprise that inflation is the number one challenge that companies report facing. When we look at products, vinyl windows and patio doors remain the overwhelming market leaders. The top requested features also remain unchanged from last year, with energy efficient products, larger windows and doors, and color as the most requested. Nearly all companies are updating, plan to update, or have new products that already meet the requirements of Energy Star 7.0. Triple pane and fourth surface low E are the top technologies company use to up their efficiency, but plenty of other technologies are in action as shown in the chart on this screen. Labor, this is back to the number one challenge that companies face. Supply chain and materials have taken over that for several years, but we seem to be back to labor as the biggest pain point. Recruitment is the top challenge around labor, followed by retention, training, and wage expansion. A couple respondents noticed that language barriers and the cognitive load can be challenging for team members learning a new role. Some companies have implemented English as a second language initiatives to bridge the gap in communication, and they've also implemented voice-to-pick technology to help some of their production team members more easily navigate the process. There's also a challenge around transferring knowledge from retiring employees with decades of experience to and taking that knowledge, formalizing it, and documenting it so they can pass it on to the next generation of workers. It's supply chain and materials, as I noted a moment ago, that's not as much of an issue as it's been in the past year. Glass appears to be the most challenging to source. And although the majority of companies, 67%, are experiencing price increases, this figure is significantly lower than last year's report, in which 99% of companies indicated price increases, with some noting them up to 30%. So both of those numbers are much lower this year. We also talk about technology and automation. This is always interesting to see year over year. Each year the number seems to creep up a bit. So we'll definitely be keeping an eye on these throughout the coming years. I'm particularly interested to track the use of artificial intelligence. This year, 40% of companies said they use it, but I've been hearing a lot more discussion around it at industry events. So we'll be asking companies about that to see how they continue using that in the future. I'd now like to turn the presentation over to Chris Beard, Director of Building Products Research at John Burns Research and Consulting, who is going to take us through the latest results from the Window and Door Market Survey.
Thank you, Lori. I'm going to share my screen briefly here. Okay, there we go. So it's a pleasure to be here with everybody. Thank you for the introduction. Just a few topics we're going to touch on today. Should get us through the remainder of the hour and hopefully leave a couple minutes at the end for questions. So I'm going to first talk about the macroeconomic backdrop for housing, what we're seeing in the overall macroeconomy. Well, certainly, signs are cloudy right now. Nobody's really sure which direction the economy is going to go, so we'll spend some time on that. Then we'll talk a little bit about the new construction housing market, as well as R&R trends that we're seeing in the repair and remodeling market. Then we'll go into the insights from our latest window and door market survey, the Q1 survey that we launched in May. We have the second quarter survey in market now, and I'll touch on that too and how you can sign up. And then we'll close out with some takeaways and hopefully some time for some Q&A at the end. So the way we see the current macroeconomic conditions are, we say home building and the broader economy are staying strong. The economy is normalizing, but on a relative basis, it's relatively strong, really boosted by surging asset prices. So think stock market valuations, as well as home price appreciation, and also significant inflows of immigration. The U.S. economy added 206,000 jobs in June, but they did downwardly revise the May and April job numbers. And immigration has fueled much of the strength of the job market year to date, but we're a little bit cautious. We're in a presidential election year, and policy decisions could quickly reverse that trend. We're seeing consumer spending continue to rise in certain areas as consumers have cash due to their rising asset prices, and stock market continues to rise. Other labor market data is really showing signs of normalization. So we are still seeing job gains, but the unemployment rate is back up over 4% after 27 months in the 3% range. And that's certainly given the Fed some caution. Jerome Powell this week made some statements around they're watching the labor market a little bit more closely, in addition to inflation, as they make their policy decisions around interest rate cuts. So month over month, employment remains strong. Here you can see the job numbers for the past couple of years, see strong growth in June, but we did note here the downward revisions, pretty significant downward revisions to April and May. So when we see the July job numbers, I also expect some downward revisions to the June numbers. So it's a cooling labor market. Really, this is what the Fed intended to do to really help offset inflation. Inflation, obviously, one of the drivers of that is wage growth. And so a cooling labor market means slowing wage growth. And that's what the Fed intended with their interest rate hikes. We're seeing the working age population grow. It's really the working age population of 20 to 64 had slowed due to retirement, the boomers retiring, but is now growing once again just because of the huge influx of immigration that we've seen last year and also into this year, the majority of which tends to be in this working age population. All eyes are on the Fed. At their June 12th meeting, which is the last time that they met, the Feds noted an improvement in inflation, and certainly we got some positive momentum this morning when the core CPI rose at the lowest rate since January of 2021, and all items inflation fell to 3.0, which is a little bit lower than economists anticipated. So the economy is resilient. We think that there is optimism among economists that we will see at least one, if not maybe two 25 basis point cuts in the Fed funds rate yet this year. This would really be a boom for housing due to affordability. But we also think it's important to note that 1 or 2 rate cuts doesn't mean that it's the start of a cycle of rate cuts. And we have an example in 1995, Alan Greenspan cut the rates by 25 basis points and left unchanged for 6 months until December. This is a possibility. If we don't see continued downward momentum on CPI, we could see 1, possibly 2 rate cuts this year, but that doesn't mean that it's going to be a long march down to where we were before the recent hikes. As a reminder, a recession typically follows within 18 months of the 6 of the past 8 rate hike cycles. The average peak at the start of a recession is about 3 quarters. So we're a little bit past there now. But there is optimism that soft landings are achievable, and now that appears to be more of a probability than just a possibility, something unthinkable just last year. Most economists are expecting to see rate cuts by December. This is a survey of the Wall Street Journal of economists, and at the end of last year, more economists predicted more rate cuts this year because they thought that inflation was progressing nicely. In January, expectations were that we would see more rate cuts, and now this is the April survey. I believe the June survey is going to come out tomorrow or this weekend, so we'll see what economists are predicting. But right now, based on the CPI numbers this morning, general consensus is we may see 2 rate cuts yet this year. Also, as a reminder, federal funds rate and mortgage rates, they're related, but it's not 1-to-1. So on average, 100 basis point hike in federal funds rate is only driving mortgage rates 43 basis points higher. Mortgage rates, as many of you know, are more tied to the 10-year Treasury yield, which has been rising recently, but did take a little bit of a step back this morning based on the more positive CPI numbers. So just because the fund rate keeps going up and up, or has gone up and up, that has not had a 1-to-1 relationship with mortgage rates. Economists do still see recession risk. It's remaining elevated at about 29%. According to economists, this is an example, and you see back in 2020 with COVID, at the very onset of COVID, recession risks were very, very high. And of course, we did see that. But even into 2022, when the Fed started hiking rates, projections were elevated for a recession. Stock prices, the stock market continues to be on a tear. Stock price valuations are really high at about 37x earnings. And you can see that's getting close to the 1999 peak where it was 44x. And then stock prices are rising for 32 out of 33 housing dependent industries year over year. So this takes the public stock prices for these industries that I have listed on this slide. And you can see year over year, those prices are continuing to increase. And homeowners continue to have near record levels of equity. We treat each market individually, so this isn't uniform across the country, but broad depreciation in home values really has not transpired. And this means that equity can be tapped for funding of remodeling projects. It also means that homeowners will continue to view their home as an investment, which gives them confidence that upgrades, they're going to continue to enhance the value of their homes. So despite all of the positive or more positive economic news that we're seeing, consumer sentiment remains low relative to history, relative to 2015 to 2019. Home values have been holding up, stock market investments are doing well, 401ks are growing, there's job growth, but consumer sentiment is still relatively low, considering back to pre-COVID times. And we really think this is the biggest barrier to a significant turnaround in big ticket remodeling. And I'm going to go into some of that when we get into the R&R insights, but contractors and remodelers are saying that, you know, just consumer sentiment and just being overall pessimistic about the economy is what's really driving a lot of this slowdown. So now we'll talk a little bit about new construction. This is from our monthly home builder survey, where we survey approximately 20% of all new home sales in the US on a monthly basis. So we measure the new home sales and starts on a community count basis. And what we do is we ask the builders of the communities that they have under construction, how many homes per community are they selling? How many homes per community are they starting? And so in June, we saw the year over year new home sales were flat year over year, but it's still very high, about 33% higher above the 2.4 June average from what we call more normal years from 2012 to 2019. So these new home sales obviously are leading into new home starts, and these were also flat year over year in June, but still 29 or 21% over the June average during these more normal year time periods. Starts are important to understand from an appreciation standpoint. So we look at how fast are prices rising. Lori touched on that a little bit earlier, but we're seeing new home prices still appreciate about 3% year over year. That is trailing the 5% resale price appreciation for existing homes, and also 3% single family rent growth. So no surprise that resale home prices are appreciating quicker just because of the lack of inventory. So those homeowners that are locked in with those low mortgage rates, they're still unwilling to sell their homes because they're locked into that rate. They don't want to take on a new mortgage and find somewhere else to live with a home that's likely going to be significantly more expensive than the home that they're in. So that's why we see resale price appreciation coming in stronger, and we expect that to continue as these homeowners continue to be locked into these low mortgage rates. We talked a lot about, and I think in our last webinar, we talked about, you know, builders and the use of incentives to really spur home buying activity. One of the reasons that new construction market is stronger, and it's about 28% of total home sales, which is a very high percentage. I think the average is around 13%. So new home sales as a share of total home sales at about 28% is significantly elevated, because builders are able to employ incentives to bring down that total purchase price for the homeowner. They're generally capped at around 6%, and we're seeing on a national average basis that the use of incentives is around 5% of the total sales price nationally. And this is up a full percentage point from what builders were reporting last May. So we ask, you know, over the past 3 years, we've been asking this since these incentives came into play, Are you offering no incentives, fewer incentives, no change, somewhat more, or a lot more, or big incentives? And 16% of builders this past May report they're offering more incentives than seasonally expected. 69% saying they're offering somewhat more to a lot more incentives. This jumped from just 3% in 2022 when builders first started offering these incentives. And we put a nice quote here from an Atlanta builder that said, you know, they're never led with incentives, but now that's the only way to get buyers off the fence. Everyone is looking for the deal, but there's no sense of urgency as consumers hunt for the bottom. Unless they have to move, no buying signals whatsoever. And the way these incentives work, we ask the builders, what types of incentives are you offering? Mortgage rate buydowns are the largest group at 26%. Another 20% say closing costs. And this is comparing the past 3 years, so 24, 23, and 22. The way mortgage buydowns work is the builder will offer the loan to the homeowner and say, instead of reducing the overall sales price for the home, which is important for builders to maintain that total sales price, again, tying back to the 3% price appreciation that I showed earlier, they're able to buy down the rate of that mortgage, the rate that the homeowner is going to be paying on that mortgage over the life of that loan, so the full 30-year term. So they're able to buy down certain percentage points for that. This year, we're seeing an uptick in this blue area, this 9%, for builders are saying that they're offering flex spending. And so this flex spending is important. It's a nuance where builders are saying, you know, we're going to give you a certain percentage of flexible cash. You can either apply that to your mortgage rate to lower your mortgage payment, you can apply that to closing costs, or you can also apply it to design options. If you're less interest rate sensitive and willing to take on a little bit higher rate, they can choose to use that cash for design options to upgrade the home. On a national basis, we said that, you know, overall sales starts were flat, and you can see there are some regional differences. Florida came in strong after being relatively weak in May. And I do want to note that some of these declines in many regions, especially California, is really not driven by a lack of interest. As builders generally tell us, there's more demand than supply. They're tempering their sales based on availability of new homes and new lots. And so they're because of lot availability and a limited supply of vacant developed lots, but builders are tempering the release of new homes available for sale, which creates lumpy sales volumes when we look at this on a month-over-month basis. Builders are really prioritizing pace or price over pace, meaning they want to make sure that they're going to get the price that they're targeting for the home, if that even means that they have to meter sales a little bit. So that's an interesting take, that, you know, don't think the sky is falling when you look at these numbers, because some of it is very intentional from the builders. And this is from our latest dealer survey we'll be releasing early next week. We talked to building materials dealers on a monthly basis, and they're starting to pick up on this deceleration of starts. We saw negative order growth for the first 9 months of 2023, and then in October, dealers started reporting positive year-over-year order growth. But then that's since come down. That's low single-digit growth earlier this year. And then in June, dealers report that their total orders fell 1%, again, due to this deceleration of new home building. Residential designers are still trying to solve for affordability. As we know, home prices keep going up. Material costs keep going up as well. And so when we asked this with our New Home Trends Institute residential architecture design study, we talked to production architects and designers as well as custom production designers. And 67% of production residential designers lowered the finish quality of a project versus 50% of custom. So you think, you know, custom home builders, there maybe have a home buyer that's not as price sensitive, yet 50% of custom residential designers said that they did have to work on materials to lower the overall cost. And when we ask what products that generally entails, they both cite cabinets and countertops as the #1 product category that they have to value engineer, if you will, to lower cost. Interestingly to note that production builders cite doors and windows as the second most product category that they're having to value engineer due to cost, whereas for the custom home architects, it's fifth, right behind flooring, appliances, and fixtures. So you can see different priorities and where builders are having to prioritize which products they're willing to upgrade and maintain versus which products they're going to downgrade. So now moving into repair and remodeling trends. We have talked a little bit in the past, but one of the big drivers of big ticket remodeling is people staying in their homes longer. And what we've been noticing, generally people were thinking that post-COVID, people stayed in their homes longer, but we've really seen a downward trend in mobility over multiple decades. This chart goes back to 1981, and you can see the general mobility rate has been declining. And so when we think about repair and remodel, we think less around existing home sales, which is a common notion, but we really think it's more tied to people moving in general, and we've seen that in a downward trend over the past several decades. Really, that balance of importance from remodeling is tilting towards households that are staying in their home and then upgrading versus recent movers. So this is an analysis that we did around remodeling spending from recent movers and existing home sales. And you can see the correlation from the three charts that we have here, 2001 to 2008. There was a very, very strong correlation between existing home sales and remodeling spending. 2009 to 2016, we saw that cut about in half. So that correlation between existing home sales and remodeling spend was really cut in half. And then from 2017 to 2022, that fell even further. And we put this quote on here from Jesse Singh, the CEO of AZEK Decking Company. And he says, "We're focusing more on consumers who are living in their homes and not transacting." And we think that's a very important point, especially as existing home sales remain very low from homeowners being locked into those low mortgage rates. Large discretionary remodels, no surprise here, likely to be financed using home equity. And so when we do start to see interest rates come down, and we do expect some of those home equity lines of credit to be unlocked and consumers tapping into that, we do expect a larger uptick in large remodeling spend. And this is just showing the percentage of remodeling projects that are paid in cash versus with cash out refinancing or home equity lines of credit. And you can see, obviously, the higher the price tag, the more that home equity lines of credit or cash out refinancing is used to fund these projects. Tighter monetary policy has really reduced that demand for home equity withdrawals. No surprise, interest rates started to rise, and we saw credit conditions tighten, and homeowners said, "You know what, I'm not going to go after that home equity line of credit that I have available just because I don't want to pay the 9% interest rates." So you could see as interest rates began to rise in 2022, we really saw interest in home equity lines of credit wane. Most homeowners had already either taken out, either refinanced their homes at really low mortgage rates, or taken cash to finance remodeling activity, among other things. But home equity lending really contracted significantly with rising Fed funds rates. As interest rates do come down, we are expecting more of that home equity to be tapped and used for these larger remodeling projects. Another item that's really not discussed a whole lot is wealth transfer. So the boomers have accumulated significant amounts of wealth, more than any other generation in history. And we believe that we're on the cusp of the largest intergenerational wealth transfer in history. We think that this money that the boomers have saved up, and to a certain extent Gen Xers have saved up, is going to be transferred to their children, or in many instances their grandchildren. We're starting to see that. We're starting to see grandparents helping out their grandkids with down payments for housing. But we think by and large, this is going to be a significant boom for housing. As this younger generation comes into home ownership, we think that there's going to be trillions of dollars of flow between the generations that's going to benefit younger generations and go to a large extent towards housing. This is from our latest U.S. remodeling index, which we'll be releasing later this week, that we publish on a quarterly basis. We talk to professional remodeling companies on a quarterly basis. And we ask them many things around that, what is activity, what does their backlog look like, how it leads, project size, et cetera. And so this is a comparison of the second quarter of 2024 compared to the first quarter of 2024. The line on the top represents the latest reading, so from the second quarter. And you can see across design build firms and home improvement pros, expectations were lowered for their activity over the next 3 months since the beginning of the year. So this measures how much business do you think you're going to be doing over the next 3 months? And we could see just from the first quarter to the second quarter, expectations did deteriorate. Still expecting growth, but we did see those expectations tamper and damper. And so, like Lori mentioned, with some of the items that we're seeing about, we did expect an uptick in big ticket remodeling towards the end of this year, and expectations as we've moved through now half of the year, we're seeing expectations come down a little bit. Most common reasons customers do not or are delaying projects is for interest rates. They're pausing or delaying projects until a future date, or spending less on remodeling projects in general. They're also knowing trade downs in product offerings or doing smaller projects than initially planned. We asked the remodelers what percentage are they seeing trade ups in product categories or in project sizes, and what percentage are they seeing in trade downs. And so this represents a quarterly reading back to the third quarter of 2021. And on the left, those are those remodelers that say that they're seeing more trade ups than trade downs. And that's registered at about 25% in the second quarter of this year, versus 34% of remodelers saying that they're noticing more trade downs. So again, remodelers are seeing more trade downs due to interest rates, affordability challenges. But it's important to note that not all product categories are the same. So just because you may have two exact kitchen remodels, for example, one homeowner may say, you know what, the countertops are not that important, I'm willing to trade down to a less expensive product. The next homeowner, the next door neighbor could say, countertops are very important for me, but I don't care as much about the cabinets, or I don't care as much about the flooring. So there are nuances within projects, and I think it's up to each individual remodeler and up at each individual firm to understand what are the categories that's important for the homeowner, where are they not willing to make compromises, and where are there potential upsell opportunities. When we ask those contractors about which products are they most seeing trade ups, interestingly, they said windows was the number one. They're seeing more trade ups in the window category. So this could be windows it could be a broad topic. We didn't get any of the nuances, but it could be upgrade in material type, so wood over vinyl. Could be an upgrade in glazing options, more deck glass, or even operating type. We don't have the nuances there, but I thought it was very interesting to see that windows is the number one product category that contractors are saying are most traded up. Remodelers cite household financial uncertainty as the largest barrier to near-term growth. So we asked the professional remodeling firms, thinking about the next 6 months, so the remainder of this year, what are the things that are holding your company back from achieving even stronger growth? We thought it was very, very interesting that higher financing costs of remodeling was the third most reason. The top reason was consumer uncertainty. So just that general uncertainty, uneasy feeling about the overall macroeconomy. Think back to the slide around consumer sentiment that I shared earlier. And so we're seeing this reflected in remodeling companies, and I'm sure many of you are seeing this in your business too. It's not necessarily the cost, although that's part of it. It's not necessarily lead times, although that's probably part of it too. It's really around that consumer uncertainty. I just don't know where the economy is going, so I'm going to hold on to my money, and I'm going to think about this a little bit longer. Another interesting point too is number 2 was skilled labor availability. So it has nothing to do with the consumer in this instance. The second most reason, skilled labor availability. Yes, we have seen growth in the working age population, as I shared earlier, but the skilled labor that contractors need to implement these projects and complete these projects for homeowner, they see that as the number 2 barrier. And that's a long-term structural issue that we've had for a number of years that we really don't see going away anytime soon. One of the things that we hear a lot, we get asked, our clients ask us this a lot, is there was a lot of remodeling activity following 2020 and the COVID boom. How much of that was pull forward, that people just spent it because they couldn't go out, they couldn't travel, so they just invested in their homes and did that for a number of years. And then as the restrictions eased, as things got back to normal, they said, you know what, we're not going to invest in our homes anymore. So we're just going to stop doing that. So we've been asked to quantify how much of this pull forward shock there was. In the vertical bar that you see at the 0 point, that represents the first quarter of 2020. So that's the beginning of COVID. And that trend line, the dark blue trend line that goes from left to right, is the pre-COVID trend. And these dot plots are showing the percentage of total consumer expenditure. So everything that a consumer spends their money on, the percentage that went into home improvement. And we use this as a proxy. We do home improvement retail sales as the proxy for R&R spend. And you can see that trend line was ticking up slightly year over year pre-COVID. And then at the 0 point, first quarter of 2020, it shot up significantly. And we estimate it shot up. It was a very material shock to the COVID industry. About 0.5 points of total consumer expenditure went to home improvement. As things normalized, as consumers got their life back to normal, as other things competed, such as services, travel, leisure, hospitality, et cetera, competed for that share, we saw that precipitously decline. And then we saw that the share of home improvement spending go negative below that trend line. And we think that this pull forward in demand that we saw, if we assume that the trend line should continue, which we do, we think that pull forward will be exhausted in the second half of this year. So that's good news that we think that once consumer sentiment improves, we do expect a reversion back to that trend of home improvement spending compared to as a share of total personal expenditures. And we think that accumulated household wealth in all its forms, so home price appreciation, stock holdings, we think that strongly correlates with spending on large home improvement projects. And we did an analysis on homeowners spend on $30,000 and above projects, which is the left axis, and then household net worth. We have seen a significant uptick in household net worth, largely driven by home price appreciation. So that asset of the homeowner owns it certainly plays into their wealth, as well as stock market holdings. So we think that the recent uptick in household wealth suggests that spending on large purchases for remodeling should follow suit, again, once consumer sentiment improves. We think this wealth effect is going to be the primary driver for home remodeling activity once this consumer sentiment does improve. So now I'm going to shift gears and we're going to go through the latest window and door market survey, and we'll talk about the first quarter results. As I mentioned, we have the second quarter survey in the field right now. We're soliciting responses from our respondents right now. And at the end, if you don't already participate, I will have a QR code and we would love to have you sign up for that. If you're in the fenestration industry, either as a manufacturer, installer, glazier, glass shop, et cetera, we'd love to have you participate if you don't already. And I'm just going to kind of go through what we saw in the first quarter, and then from there we'll go into some takeaways. So a little bit about background on this survey. It's an exclusive partnership between Window and Door Magazine, National Glass Association, and John Burns Research and Consulting. It is a quarterly survey of residential manufacturers, glass shops, glaziers, and installers. And then it's a measurement of volumes, revenue, lead times, backlog, supply chains, and all of the other things that I'm going to talk about here in a second. And what we do is we look at quantitative data. So what are the numbers that companies report, as well as qualitative commentary to really understand the overall sentiment of the industry. One of the things that I want to stress, I've talked about this before too, is I know this industry, I come from this industry, and I know that it is very, people like to keep things close to the vest. So we guarantee complete anonymity and confidentiality. In no way will any responses ever be able to be tied back to the organization or to you as a respondent personally. We completely anonymize it. I can't see who said what about anything. So it is completely anonymous. So you can be assured that your responses will never get out, that it was directly tied to so-and-so from company X said this. That will never happen. We think it's really important, and I can't stress that importance enough. So you can have complete confidence if you'd like to participate. So 4 key takeaways from the first quarter: we saw a cloudy winter, but a bright summer was expected. Companies reported an improved revenue outlook. They have hiring plans to support growth. They're saying it's somewhat easier to find and retain talent. And then finally, we're seeing benign material and labor inflation. So in the first quarter, 58% of respondents that volumes declined year over year on average by 2.3% in the first quarter. We think this number is probably a little bit low. We think volume declines were a little bit higher than that. But it is interesting to note that volumes did decline, right? And so if we think about the first quarter of 2023, A lot of companies still had backlogs that they carried into the year. So these backlogs, what we heard in some of the qualitative commentary, these backlogs were non-existent coming into 2024. And so they started off already kind of in a hole because they weren't working through backlogs. Revenues also declined. It was the first time since we've been asking the survey that we saw quarterly revenues decline on a year-over-year basis. 53% of companies said that the revenue did decline year over year, on average by about 1.1%. I do want to note, though, when we asked this question in the fourth quarter, we asked each quarter, we said, what do you think revenue is going to be next quarter? And in the fourth quarter, respondents said that they thought revenue was going to decline in the first quarter by an average of about 2.7%. So the fact that revenue declines only came in at about 1.1% on average shows that revenue expectations did come in a little bit ahead of expectations. When we ask about inflation, we ask about raw materials inflation as well as changes in direct labor. We know that labor is continuing to get more expensive, but we're seeing relatively benign inflation for raw materials, up only about 1%. So that's right in line with historical trends, pre-COVID, inflation boom in 21, 22, and into 23. And labor costs are also still accelerating. 5% is pretty significant, but it's come down significantly from double-digit labor inflation that companies reported at the end of last year. 47% of companies were able to reduce their backlogs in 2024, but only 24% responded increasing backlogs. Again, coming into 23, there are a lot of backlogs still on the books from 22. Those backlogs were really non-existent, had been worked through throughout the year in 2023. And so 47% said their backlog change is down year over year. We ask about lead times. Lori touched a little bit on this earlier too. We say what lead times are extended, which is really pushing out some of your cycle time. The good news is 57% of manufacturers said it's not applicable, and that means that there were no issues. We had seen issues in the past around float class to a higher percentage. IGUs, 25% said in the fourth quarter that IGUs were backlogged and delayed. That was leading to extended cycle times. But 57% said that there were no issues. They're getting all the materials that they need to be able to keep their projects on schedule. We were a little bit concerned about transportation issues, especially from hardware or other components that may be coming from overseas. And we did hear rumblings about that in the first quarter, where it said, we're kind of watching this with the global delays in shipping. But manufacturers do seem to be navigating that pretty well, and we're not really seeing any transportation issues. Again, when we have our Q2 results, that may change. But for right now, in the first quarter, that's what they reported. 68% of companies said they are expecting higher revenue in the second quarter versus the first quarter. Really no surprise. Second and third quarters are prime selling seasons. So compared to the first quarter, that's not really a surprise to expect revenue quarter over quarter, expecting revenue on average up by about 6.4%. And then for full year, 53% of companies are saying they plan to exceed their 2023 revenue numbers by an average about 5.5%. So 5.5% revenue growth in an off year, that seems pretty good. But we also asked companies of what their price increase expectations are. And 63% of companies said that they're planning to or have already raised list prices year over year. And on average, that came out to about 4.7%. So going back to the previous slide, companies are expecting revenue to increase by 5.5% and prices to increase on average by 4.7%. Indicates that there's probably not a lot of volume increases that we're seeing. So one of the things that we're introducing this quarter is we're actually asking companies for their full year outlook, not just on revenue, but also in units. How many units are you projecting to produce more of or ship less of than last year? So we think that when we come out with the next report here in a few weeks, we'll be able to see that from a dollars perspective, which obviously is very important, but also from a unit perspective, which is going to give us good insights as far as how the industry is trending. 58% of companies said they're not planning to make changes to their production workforce this year. 33% said they're planning on adding to production workforce, again, anticipating an uptick in demand later this year. And only 8% said that we're planning on reducing production workforce or eliminating lines. So that's really good news that companies are optimistic about their outlook and they're not willing to reduce their production workforce, fully knowing that it is difficult to hire and retain talent. When we ask about sales and marketing resources, 60% of companies said that they're planning to or have already added sales and marketing resources in 2024, versus 40% said they're not going to make any changes. But the big note here is 0% said they're planning on reducing sales or marketing resources. One of the things that we've been hearing over the past several quarters is now that we're past the COVID boom years, now that demand, off the charts demand has kind of waned, companies are having to relearn how to do old-fashioned sales, how to go out and get business, how to hunt for new business, negotiate, and also build up preference too, consumer preference, but also preference with builders and contractors. During the COVID boom years, as you all are well aware, contractors, builders were just taking whatever product they could get. They may have had brand loyalty before, but of product availability with extended lead times that really plagued the fenestration industry. Builders and contractors were saying, I just need a product that's going to fit in this hole, give it to me. But now companies are starting to realize now is our chance to win back some of that business. So they're investing heavily in sales and marketing resources to win back that loyalty, to win back brand recognition from consumers, to really promote their value proposition with builders and contractors. And so really no surprise that 60% said that they're planning on adding to sales and marketing resources. Similar to what Lori shared before, we asked what the #1 focus area is for 2024. Production automation and design styles were both came in at #1. Each respondent said, 21% of respondents said this is the main focus area for each. So again, thinking about the labor situation, thinking about efficiency improvements that companies are hoping to achieve, production automation is the #1 reason. And then we asked about finding and retaining employment. Has it become easier, harder as we're seeing the labor market loosen a little bit? We really wanted to dig in. Is the wave of immigration that we saw last year and seeing this year, is that having an effect? On a broad scale, our respondents said they're not really seeing that, but they are saying 39% of them said it's becoming a little bit easier, or it's a lot easier to find and retain talent than it was a year ago. Again, job openings per unemployed person are lower than they have been. They're back to 2019 levels. Job quits are down. People are staying in their jobs longer. So as this overall macroeconomic uncertainty continues to take hold on America, companies are saying that they're seeing a little bit looser job market. 44% said it's about the same, and then 15% said it's a little bit harder or a lot harder. And then we asked, what are the main things that you're doing to attract and retain talent in your facilities? The #1 thing, 63% said they've increased their base pay. Interestingly, #2, 47% had nothing to do with pay, but they're saying they're enhancing their training or they're enhancing the onboarding experience. So when you have a new hire come in, or you've got somebody who may be shifting roles within an organization, really enhancing that experience to make them feel that they're up to speed on what they need to do, expectations are set, and they're able to be successful in the role. That's the #2 reason for being able to hire and retain talent. 42% said increasing benefits, could be anything from paid time off, additional 401k contributions, paying more towards healthcare. And then the 4th was adding technology to really improve efficiencies, tying back to the other point around production automation being a main focus area. So that was the window and door survey for the first quarter. And I'm going to go into some key takeaways, and I do think we have several minutes for some questions. So first key takeaway, the macroeconomy is cooling just as the Fed intended. That soft landing does seem achievable now, actually looks more probable. The labor market's easing, but hiring remains robust, and job openings are back to 2019 levels. And the workforce is expanding, really boosted by the immigration surge that we've seen over the past 2 years. New construction is remaining strong, but it is decelerating. Builders really need to employ those incentives to really get home buyers off the sidelines. And they're continuing to substitute products due to lower cost alternatives to solve for that affordability. That's still building materials prices continue to rise, and builders are trying to keep their overall costs down to keep the growth in new home prices down as well. R&R market is continuing to be pressured by higher costs, and we're seeing consumer deferral of large projects continue. Professional remodelers are downgrading their expectations for the near term for the remainder of this year. And consumers continue to defer projects following the boom in COVID. Again, that economic uncertainty, that consumers just don't know where the economy is headed. They're holding back on these big ticket discretionary purchases and large ticket remodeling projects. And this COVID pull forward that we were able to quantify, that is going to be exhausted in the second half of this year, which should be a positive boom for remodeling once consumer sentiment improves. Window and door companies are expecting revenue growth in 2024 following declines earlier this year. Very few companies plan on reducing production labor. 50% of saying they're going to add to sales and marketing resources. Companies are reporting easier hiring conditions, which is consistent with the slowing labor market. And then to wrap it all up, we think that the fenestration industry is really poised for growth once that consumer optimism returns. Initially, we were saying we expected that to be in the back half of this year. Now we're saying timing is relatively uncertain just due to the overall macroeconomic conditions. Positive momentum recently may help drive that growth. Interest rate cuts will certainly help too. But then there's also the wild card of the presidential election too. So we're really unwilling to say, when we think that strong growth is going to return. But one thing I think everybody does agree on is just because of the demographics and just because of the importance housing has on the economy, that we do expect strong growth in both new construction and repair and remodeling. So this QR code is to participate in our quarterly survey. Like I said, we have that in the field now. It's going to be open for another couple weeks. If you don't already participate and would like to, please feel free to scan this QR code, and then you'll be sent to a sign-up form. We'll get your information, and we'll send out that link to you. And then here's my email as well. If you have any questions, feel free to email me, and I'd be happy to answer any questions that you have via email. And I think we still have about 5-6 minutes to go through any Q&A that we may have today. Thank you.
Thank you so much, Chris. Your presentation had so much really good information and insight into it. It's a lot to digest.
Thank you.
We do have a couple questions that came in. The first one is, what is the expectation or prediction of market growth after the election?
The last slide I said we're having difficulty saying what the timing of that is going to be. So I'll put that corollary on it. The election, there's been a lot of talk around the election, and there's a broad belief that consumers typically hold back on purchases due to the uncertainty of the election outcomes. We looked at the past several election cycles, I think going back to the 1980s, and we see that's actually not really true. We don't really see a huge inflection in or downturn in remodeling spending based on the election. This time it's different because we happen to be in a soft housing market due to interest rates, affordability, all the other factors that we talked about. The probability of the election seems more certain, I'll say, over the over the past week or two, and I won't go into more details than that. But there seems to be more of a consensus around who they think is going to win the election. So that, and another reality too is the past couple election cycles, we never really left an election cycle. The 2024 election began the day after inauguration in 2021. So it seems like, and I've heard this commentary from many people in the industry too, like we're in a continuous presidential election cycle now, or at least it seems like it has been over the past 4 to 8 years. And so don't really think that that's going to be impactful to remodeling spending as much as it maybe had in the past.
All right, thank you. The next question is from Adam. He writes, it feels a bit at odds that the number one issue for most builders and consumers is affordability, and yet manufacturers are planning on further increasing prices. At what point do we expect to see some level of discounting or ease in pricing, especially as manufacturers increase their sales staffs and start fighting more actively for volume?
That is a great question. And and I have a smart aleck response, and then I've got another response. So in 2022, I went to the build. So after interest rates increased, new home starts slowed significantly as a response to the interest rates before builders really started to employ these incentives. I went to building material dealers that I worked with. I worked with a large group of independently run pro dealers, and I said, when are prices going to come down? When are the manufacturers going to call you up and say, here's a list price cut for my window units? And they all kind of looked at me, and I said, I'm kidding. I know that doesn't really happen. And they said, yeah, it does for finished goods. Prices really don't haven't really seen come down. That being said, building materials costs are approximately 40% higher than they were in 2019. Inflation had an impact. And so we saw significant price increases through 2022. What we generally saw was 2023 prices were relatively flat, and now we're seeing kind of that reintroduction, that normal cadence, that normal 3 to 5% annual price increase that we're seeing, at least in the windows and doors space. But also in other categories too. I'm very surprised that 3 categories I'm going to call out, not related to windows, but still in building products is important, is roofing, insulation, and wallboard. Those 3 product categories have both, or all 3 of them have come out with at least 1, in many instances 2. In the case of roofing, it's been 2 to 3. Insulation, it's been 2 price increases yet in 2024. The reason is, even though wallboard, so drywall and insulation volumes have been down year to date throughout 2024, because those volumes aren't yet translated into the new homes that have been started, and then certainly the continued weakness that we're seeing in R&R. And then roofing has had the opposite effect. Roofing demand has been really strong from storm damage recovery from storms in 2023. That's carried through the first quarter, second quarter of 2024. But going into the third quarter, which we're now in, we do expect roofing volumes to decline, yet all manufacturers put in a 4 to 6% price increase beginning August 1st. So we're still seeing that upward momentum. We saw relatively benign inflation, and Laura, you shared some of that data too, benign inflation in raw materials in 2023, but I don't think there was a lot of deflation. Deflation meaning raw material prices went down. So that's kind of normalized. Certainly, list price reductions don't happen too often, generally speaking. I'm just speaking in general terms. I know they do happen in certain instances, but then there's other mechanisms like back-end rebates that are given for volume, et cetera. But even our builders are saying, we asked this, I didn't include this slide, but we asked this in this last quarter. We asked the home builders, how much have building materials costs gone up this quarter? And they said in May, they went up 3% in the first quarter. So building materials costs continue to rise too. Labor inflation is still present. Raw material inflation seems to be coming back a little bit too. Transportation inflation is relatively benign, but ocean rates have gone up. Trucking starting to go up a little bit too. So inflation is still there. So I'm not expecting broad-based declines in building materials outside of things, commodity products such as lumber and OSB.
All right, thank you for this very thorough presentation today. And thank you to everyone who joined us for the afternoon. As I put in the chat, you can expect to receive an email from us tomorrow afternoon. It includes a brief survey about the presentation, as well as a link to the recording and handouts as well. Do mark your calendar for our next Thursday on August 15th. And we do hope to see many of you either at the NGA Glass Conference in Milwaukee or Glass Build America in September in Dallas, or even better, both. But nonetheless, we hope to see you soon, and have a great afternoon.